You've probably heard of JM Financial. They're an absolute titan in India's financial world, the go-to firm for all the biggest deals. So why are their profits suddenly under pressure? Well, it turns out they're making a massive and pretty risky bet on the future. Today, we're going to break down their bold strategic pivot.
Okay, first things first, let's get one thing straight. In the high-stakes game of Indian investment banking, JM Financial isn't just a player. They're the undisputed king. They're the firm that sits right at the very top.
So when a big company needs to raise some serious cash, who do you think they call? Yep, JM Financial. You can think of them as a total powerhouse on Dalal Street, which is basically India's Wall Street. Okay, so here's the big puzzle, right? If they're the absolute best in the business, why are their profits taking a hit? To figure that out, we've got to look past the headlines and really dig into what they're doing strategically. First, to really get what's going on, you have to appreciate just how rock-solid their core business actually is. Think about their investment bank like a famous landmark building on the skyline. It's been around for decades, it's super profitable, and everyone sees it as a symbol of strength and stability in the market. And these guys are always busy. I mean, look at these numbers from just one fiscal year. They handle dozens of huge, high-stakes deals. We're talking about the whole shebang. From IPOs, when a company first goes public, all the way to massive block deals. All of this just cements their #1 spot. Okay, so now for the twist. Remember that strong landmark building? Well, imagine they're building a brand new, massive skyscraper right next to it. And as you can probably guess, that kind of construction costs a ton of money. They're just pouring cash into new businesses like wealth management. Get this. They doubled their team of client relationship managers in a single year. But here's the catch, and even their own management says it, they're paying all these new salaries now for revenue they hope to see later. And it's not just people. They're also betting big on new digital platforms. Now, right now, these are operating at a loss. It's the classic definition of short-term pain for long-term gain, right? They're investing heavily today, and that's what's dragging down the overall company profits, for now. So, the big question is, are these expensive new bets actually showing any promise? Let's take a look at the momentum they're starting to build. 26%. Wow, that's how much their assets under management, or AUM, grew in just 1 year. What does that mean? It means wealthy clients are trusting them with way more of their money to manage and invest. That is a huge vote of confidence. And check this out, 59%. That's the jump in their SIP book. SIPs are systematic investment plans. It's how a lot of everyday people invest a fixed amount each month. A jump this big? It proves their strategy to go after smaller, individual investors is really starting to work, creating a nice, steady income stream. And that's not all. They're also cleverly using their investment banking smarts to launch a whole suite of new investment funds. Things designed to capture different slices of the market. Everything from pre-IPO deals to real estate. Okay, so while they're building all this new stuff for the future, they're also making sure their foundation is rock solid. And they're doing that by unlocking a ton of value that's just been sitting on their balance sheet. Management has laid out a super clear plan for this. Their goal is to basically recover a massive amount of cash. We're talking well over $100 million from their existing real estate and distressed assets over the next few years. So the whole strategy here is to get away from holding these huge wholesale loans on their own books. And honestly, it's a really smart move. It cuts down their risk and, more importantly, it frees up a ton of capital that they can then pump back into those high-growth areas we were just talking about. And speaking of risk, their risk management is incredibly sharp. Just look at their affordable housing business. They're lending to folks who might not have a perfect credit score, but, and this is key, they keep the loan amount pretty low compared to the property's value. The result? It's amazing. Their rate of bad loans is less than 1%. In this business, that is remarkably low. All right, let's bring this all together. Because this whole strategy connects to something much, much bigger. A massive bet on the future of India itself. See, the company's leadership isn't just thinking about next quarter's earnings. They're looking at a fundamental shift happening across the entire Indian economy. As their vice chairman puts it, the next decade in India actually belongs firmly to capital markets. So what does that mean? Well, as millions of Indians get wealthier, they're going to start looking for better returns than what they can get from a simple savings account. That means more and more money is going to flow into the stock market. And that creates a huge, growing demand for the exact kind of services that JM Financial is spending so much money to build right now.
So here's the bottom line. This isn't just a minor corporate reshuffle. What we're seeing is a very deliberate, very expensive, and strategic pivot. They're moving away from their traditional comfort zone to position themselves to capture the next massive wave of wealth creation in India.
They're sacrificing profits today for what they hope will be total market dominance tomorrow. It's a classic long game. The big question for investors and for the market is this: will this massive bet pay off?